Hello, investors and traders. As you know, the goal of this YouTube channel is to help you develop your own investing or trading system. We follow over 100 indicators to increase our probability of success in the stock market. Every week, this channel not only provides you with these indicators and insights into the market psychology, but also our recommendations on the overall market sectors and individual securities. In this video, we're continuing the series covering various indicators. Today's focus is video 4, indicator 4, CCI indicator commodity channel index. One indicator alone doesn't create a system, and that's true for the CCI indicator, which on its own has below average success rate. However, I've identified scenarios where CCI indicator has a high probability of success. We'll cover high probability trading with the CCI indicator and investment strategies using CCI indicator. We'll explain the basics of the CCI indicator and how to combine this technical tool with other indicators to build a strong investment strategy. Our catchphrase: study it, analyze it, adapt it. What we want to accomplish here today is what's called high probability decisions. But first, we must answer a basic question. What is the Commodity Channel Index, CCI? The Commodity Channel Index, CCI, is a momentum-based oscillator that helps identify when an asset is approaching overbought or oversold conditions. Developed by Donald Lambert, this technical indicator analyzes price trend direction and strength, giving traders insight into whether to enter or exit a trade, hold off on trading, or add an existing position. Despite its name, Commodity Channel Index, CCI, can be used in any market and is not limited to the commodities alone. By interpreting specific movements in the CCI, traders can use it to generate actionable trade signals. We will have a predefined rules and conditions to make choices off the Commodity Channel Index. Some key takeaways. Purpose: CCI is a technical momentum-based oscillator used to identify overbought or oversold conditions in an asset. Calculation: it measures the difference between the asset's current price and its historical average price. This calculation is a difficult one to figure out by yourself, but all trading software has the CCI calculation inside. The Commodity Channel Index, CCI, is a technical indicator that measures the difference between the current price and its historical average. A CCI above zero indicates that price is above the historical average, whereas CCI below zero suggests it is below the historical average. Many times in a bull market, the security, the index, stays above zero. And many times in a bear market, it stays below zero. Since the CCI is an unbound oscillator, it can move indefinitely higher or lower. Therefore, overbought and oversold levels are typically defined individually for each asset by observing historical extreme CCI levels where price reversals have occurred. This indicator is an oscillator. Most oscillators, an action happens and then it can trigger the event of using the CCI indicator. We have seen at extreme levels, even though this is an unbound oscillator, it can work better than oscillators that an action happens and then gives you a buy signal. Sensitivity adjustment. Traders can adjust the CCI period, typically 20, to control the sensitivity. Shorter periods react more quickly, while longer periods smooth out signals. Key points to success. The CCI is a market indicator that helps track movements, which may suggest buying or selling opportunities. The CCI indicator in your strategy should give you a buy or sell action when certain events happen. The CCI compares the current price to the average price over a specific time period. By changing different parameters in the CCI, you might get a better result. Also, what type of trader or investor are you will be based on this average price or this parameters you put inside the CCI. Various strategies utilize the CCI in different ways, such as applying it across multiple time frames to identify dominant trends, pullbacks, or entry points into the trend. It's so important for you to learn your own system. It's so important not to take belief in anybody else's system. Many people, many systems take a part of the CCI and put it in their system and come up with a name for it. You can understand how powerful this CCI indicator is. I can tell you out of all my videos for indicators, the most popular indicator that is viewed is the CCI indicator. And there is a reason for that, because people can make a system out of it and have a probability of success. Some trading strategies based on the CCI can produce multiple false signals or losing trades when market conditions become choppy. The CCI indicator alone will not make you a winning trader. The best, they'll give you a 50-50 shot if you follow the way the book takes it. Thus saying that, I have seen certain times during a year period where the CCI indicator has a very high probability of succeeding. I am an independent trader and investor. I do not take money, so the amount of trades I make is not as important as the high probability of trading. Many hedge fund managers, many investment planners, they are looked on a monthly or quarterly basis. So if you can use the CCI indicator 4 times a year for a high probability trade, this can work very well for the individual trader. Nothing is as easy as it sounds, because you must study this. You must make your own system. You must combine some indicators with the CCI to give you a high probability of succeeding. But thus saying that, during extreme periods of the commodity channel index, CCI, it's a higher probability of succeeding. The CCI compares the current price to an average price over a period of time. The indicator fluctuates above or below zero, moving into positive or negative territory, while most values, approximately 75%, fall between minus 100 and plus 100. About 25% of the values fall outside this range, indicating a lot of weakness or strength in the price movement. We have told you, this is an unbound indicator. And even though approximately they will fall between minus 100 and plus 100, I have seen certain securities go to minus 250, minus 300, and vice versa. This is the sweet period that I'm talking about, at extremes. A period refers to the number of price bars the indicator will include in its calculation. The price bars can be 1 minute, 5 minute, daily, weekly, monthly, or any time frame you have accessibility on your charts. The longer the period chosen, the more bars in the calculation, the less often the indicator will move outside minus 100 or plus 100. Short-term traders prefer a shorter period, fewer price bars in the calculation, since it provides more signals, while longer-term traders and investors prefer a longer period, such as 30 or 40. Using a daily or weekly chart is recommended for long-term traders, while short-term traders can apply the indicator to an hourly chart or even a 1-minute chart. To tell you this is not a powerful indicator would doing you injustice. To tell you many black box systems use the CCI in some way combined with other indicators or other macro views, this is 100% true. The first, the best, the most important part for me for a high probability trade is looking at overbought and oversold basics for the CCI indicator. I told you at the beginning of the video, how do you put a high probability on the CCI if you take extreme levels on the CCI indicator? This will give you a high probability of succeeding by itself. Thus saying that, we will take other indicators to combine with the CCI to give you a weight of evidence. So if we have, let's just say, an extreme level of oversold in the QQQs, the diamonds, and the spiders, then we have 4 other indicators that are at extreme levels. This is what I'm talking about, high probability of succeeding. And when the CCI indicator gets to an extremely either overbought level or oversold level, there is a good indication. Let's go over the basics of overbought and oversold. Generally, the value of the CCI being above the 100 level to the upside is termed overbought. Conversely, a CCI value below minus 100 level is said to be oversold. Overbought and oversold thresholds can vary greatly from individual stocks. This is just an average, the plus 100, the minus 100, or 200 and minus 200. More volatile markets will have greater thresholds. It is not uncommon for stocks to have thresholds above 200 or below minus 200. CCI is an unbound indicator, meaning it can go higher or lower indefinitely. For this reason, overbought and oversold levels are typically determined for individual assets by looking at historical extreme CCI levels where the price reversed from. I'm going to drop a little bit of a whole system while we're going over this overbought, oversold. So first, we have an approach called forest to the trees strategy. We look at the overall market, break it down into sectors, and then break it down into individual securities. We have many indicators to tell us which direction we are going. Are we in a bullish market or a bearish market? If we know the overall market, and let's just say we are in a bullish market, and then we get to an oversold reading in a bullish market, there is a high probability chance of succeeding. Let's go even further and say we are in a bullish market with our indicators. Using the CCI indicator, we get to an extreme level coupled with 4 other indicators telling us to buy into this market. The probabilities of succeeding is very high for you. When I tell you on a major part of my trading portfolio, I do not trade very often, maybe 4 to 7 times a year. And I will wait for the CCI indicator to go to extreme level to take a reversal trade in the opposite direction. The key point is don't fight the overall trend of the market. If we are in a bull market, be cautious on the shorts. But extreme levels on the oversold assets on the CCI is a screaming buy. And not only that, it will not work as a typical oscillator where it takes 2 days to turn into a buy signal because it is at extreme level. So the macro picture also becomes important in getting a high probability trade with the CCI at extreme levels. Again, overbought could mean 200, 300, 400, and oversold could be vice versa. But by looking at a chart, you can see where a certain security or a certain ETF macro trades into it. Thus saying that usually when a security or ETF trades above the zero, it's very positive and you'll see many bounces off of it. But you will get, even in a bull market, 4 times a year, we go into this oversold level. This is what I was talking about at the beginning of the video, how important the CCI indicator is. Throughout my trading career, looking at extremes has helped me a lot. For example, with the VIX and the VXN. Let's take a look at CCI at extremes. If we put a level of 200 plus minus 200, which is an overbought, oversold level, we can look at parts where it has become extremely extreme levels throughout the years. The more years that is at extreme, the more possibility of a reversal. We're going to wait for the CCI to hit an extreme level, and then we're going to look to take a reversal trade in the opposite direction. A key point is don't fight the overall trend of the market. For the last 10 years, overbought levels on the CCI has not worked as well as the oversold levels. So do not fight the overall trend of the market. If we are in a bull market, be cautious on the shorts, but extreme levels on oversold assets on the CCC are a buy. So look at the macro picture. It becomes very important. We have videos about an approach called forest to trees strategy. Again, the CCI is very effective at extreme levels while following what has been a positive trend. Line crossovers on the CCI high to low with a 0 being the middle ground. Once the CCI crosses above the 0 line, it is an entry signal buy. When it crosses below the 0 line, it is a sell. The reason the 0 line is a powerful entry is if you look at the CCI as a moving average crossover, we will see the zero line is where the moving averages crosses over the crossovers. That is if you look at the CCI as a 1 period moving average and a 10 period CCI period. This period is a moving average. Once your typical price or your asset crosses over the longer term moving average of the typical price, these are the areas you will see hitting the zero line on the CCI indicator. So as we cross below the zero line, the typical price is crossing below the longer term moving average of the typical price, giving us a bearish entry as the CCI crosses above, that is our typical price of the asset, exceeding the moving average, giving us our bullish buy entry for the CCI. Couple overbought and oversold signals using the levels that the CCI has defaulted, which is 100 and negative 100, and those levels are picked by the creator of the CCI to account 75% of your price action is going to happen between those lines, and that is the denominator of the calculation 0.015 to ensure that approximately 75% of price action occurs between those levels. Once we exceed one of those levels, we are entering maybe an overbought or oversold signal and looking for a momentum burst. CI above zero indicates price is above the historic average. When trading above zero, the current price is above its historical average. CCI is below zero, the current price is below its historical average. Low readings below negative 100 indicate the trend has been to the downside. Readings above 100 indicate there has been a trend to the upside. As you see by the graph, when the CCI trades above zero, it set off a long-term bullish trend on this security. It is very helpful when the CCI crosses above zero for the long side and when the CCI crosses below zero for the short side. Remember to pay attention to the overall macro view. Based on this information, on emerging bullish trend would be going from negative or near zero readings to 100 can be used as a signal to watch for an uptrend. Move from below zero to plus 100 is getting ready to move higher. A pullback to the zero level can be a buying opportunity. When the stock is moving to the upside is when to get in. CCI is very helpful. Let's look at this chart. When the CCI readings fell under minus 100 at somewhat extreme lows, it shot off below zero, and when it crossed below zero, it had a great run. So many traders use it falls below minus 100 and then recrosses above the zero line and stays above the zero line for a bullish movement. Confirming a bullish trend during a strong uptrend, the CCI will typically remain above the plus 100 level. Staying at higher levels may confirm the strong trend as long as the CCI remains above 100. Just a key point, remember, extreme peaks we talked about in the beginning of the video. When the CCI stays above zero or even moves above 100 and stays there for a long period of time and trends in that direction, this also is a signal of a long-term bull move. At the beginning of the video, we told you that on this security, a negative 200 is an oversold level. We went back many years to see that these levels have not been broken, which means an oversold level. And on the opposite side, the above 200, where the security kept going up and up and up and would not go down, and we went back 3 or 4 years, the CCI works very well to show you an overbought level. Remember, Do not go against the macro, the overall market. So if the overall market is positive, which it has been for the last 10 years, and the CCI goes to an extreme level, there's a great opportunity to buy. If the market is negative or a security is negative and it reaches extreme levels of buying, it is overbought. Those are at extreme levels. But let's take it at below average levels and downtrending levels at the beginning, minus 100 and minus 200. If the majority of time the security is in the below average area and especially hitting the downtrending area, this is a poor stock. This is a stock to short. You can see the historical weakness of this stock. Next, let's talk about the above average and uptrending. If the security is trading from 0 to 200 or in that range, it is a time and showing great strength in this security. Sometimes this security might go low to the downtrending, but it quickly goes up to the above average and hitting the uptrending cycle. This is a very powerful stock. Let's hit a scenario. The overall market is positive. The macro is positive. Bad news comes out over the market and sends the market down for 3, 4, 5 days, 7 days, which sends the CCI down to a very low oversold level, extreme level. It stays at this extreme level and bounces for 3 or 4 days. Then suddenly it crosses the 0 level, which sets off a buy signal, and it continues for the next 3-4 months in the above average uptrending cycle that it is in. The CCI is a powerful tool, and if you come up with your own set of rules or even follow this video set of rules, it will help you in your financial and trading success. Remember, come up with your rules. CCI divergences. Divergences is when peaks in price action are not confirmed by the CCI. Bullish divergence is when the stock is making new lows, but CCI does not. Bearish divergence occurs if the stock is making new highs while the CCI is not. Price is going one way, but the CCI is going another way. The theory in this case is that price ultimately resumes in the direction of the CCI. In this chart, the divergence that we have here is the price was falling lower, but the CCI was not. Again, if you look at this chart, the CCI was not confirming a lower price, thus making a divergence, thus setting off a major uptrend. Insight strategy 1. The overall strategy is taking the multi-year, yearly, or low to high levels of the CCI and combining this indicator with a MACD, disregarding all signals which are against the overall trend of the market. Exit plan is a swing trading oscillator, but letting the winners run. Our risk management is implementing a stop loss. CCI indicator combined with the MACD. Rule 1, follow a top-down approach. The top-down approach to investing focuses on the big picture or how the overall market is trending. If the overall market is doing well, chances are the CCI strategy combined with MACD will also do well. What's the trend of the market? If it's negative, you'll want to do very little, if any, buying. Even if you see some stocks breaking out, your probabilities of success are quite low when the market trend is going against you. On the other hand, if the market is doing well, this combination of indicators back tested has amazing results. For this case study, we will assume the overall market is bullish, but remember, we could be in a bear market. If in a bear market, use the opposite rules in this video. Rule 2, commodity channel index indicator drops to lower levels, yearly lows, or multiple year lows. If we wait for a CCI reading that falls to a recent low, then we are going to look for a reversal trade in the opposite direction. Just because it fell to a recent low or a multi-year low or an extreme low does not mean we buy, but is an indication we could buy soon if other factors happen. So the CCI is the get ready to buy signal. So if the CCI falls to low levels, multi-year lows, or lower lows, then we proceed to rule 3. Rule 3, MACD buy signal. MACD is more of an oscillator identifying key turning points. It does an excellent job at high points and lower points, but does not do a good job in a narrow range. When you get a buy signal for the MACD, it is a time to enter. An added rule you might want to throw in, sometimes I like to see a close above a day or a few days highs for a further confirmation. Words are one thing, but let's go to the chart. This is the infamous COVID-19 sell-off. The CCI indicator was hitting lower lows, but this would not be a time to buy at this level over here. We would wait for an initial MACD signal. So while we hit a lower on the CCI, it just told us to watch, and we watched as it went lower. Then suddenly we got a MACD buy. This MACD buy was confirmed by closing higher and also holding the lows, which just sent us off into a huge rally. Again, CCI was the let's look at this. Soon it will be time to buy. MACD, the trigger, confirmation, an easy series of events, but a very powerful series of events. For the best results for the CCI indicator combined with the MACD is the initial breakout. The initial breakout is usually the most violent upswing, and the shorts are covering and people are buying into it. So again, initial breakout is what we're trying to look to find. Best results. CCI histogram turns positive. Once the CCI crosses above the zero line to the positive, it is a further confirmation of the entry signal buy. CCI above zero indicates price is above historic average. When trading above zero, the current price is above its historical average. An emerging bullish trend would be going from a negative or near zero readings to 100 can be used as a signal of an uptrend. So CCI turning positive on a histogram is further confirmation of the buy signal. Some investors and traders base their whole system on crossing the zero line. We can do further buying crossing the zero line, but the initial buy, I believe, will show best results when using the MACD. Best results, stay above 0 to 100. Confirming a bullish trend during a strong uptrend, the CCI will typically remain above the 100 level. It must remain above the 0 level. Staying at higher levels confirms the strong trend, and by staying away from falling below the 0 readings shows a bullish move. Exit a trade, protect the profit. The increased volatility in the stock market is a two-edged sword. On the positive side, it gives us a chance to make money even faster. On the downside is that when a reversal occurs, your stock can drop more quickly. The exit strategy will keep your decision-making simple, objective, and unemotional. You also won't have to consistently rethink whether it's time to lock in your profits or cut short your loss. This simplification of the selling process is more important than ever with the market becoming increasingly volatile. You don't want to suddenly sell a perfect, fine, uptrending stock simply because of a whim. In the more likely and happy circumstance that your stock starts to move higher, here's what to do. As long as the stock is above its rising 200-day moving average and the moving average is rising in uptrend fashion, be sure to give it plenty of room to gyrate with using ATR stop loss. We are going to trail the sell stop behind the advancing price. Risk management. The first thing any good trader or investor should do is realize that they must never hold any position without a protective stop loss. These issues can really change direction in a hurry when bad news comes out and the institutional herd starts to panic. The way to protect yourself is by using stop orders. Using sell stops results in a minimum of emotion and misgivings. Best of all, there will be no gut-wrenching decision making. Enough theory. Let's look at some real-life examples so you will feel comfortable adjusting to this strategy in the future. Let's start looking at the CCI. If you look back at the infamous COVID days, the CCI was hitting yearly lows, very low readings. And you see it right here. This was only a warning signal. If you just used the CCI, you would have gone lower, 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 lower. Then a MACD buy signal happens. MACD works very well in changing of trends. It does not work very well in a narrow range or just trading back and forth where it's going MACD sell, MACD buy. But it works very good at a changing trend. And then it sets off to the races. The MACD goes up, up, up. We throw out these MACD signals because it's going against the overall trend of the market. We also see that it's trading in a range of 0 to 100, even sometimes happening a little bit higher, which is showing great, great signs. Then over here, it dips. Now, you could have maybe taken your profit somewhere here and waited for it to go back over here and rebuy back in, but letting the position run would have been very good also. Staying above always the 200-day moving average and continuing forward. Now, again, paying attention to the overall market is very important. Taking profit sometimes is important, but if you follow the strict definition, you would have run the full QQQ since the COVID days. Works out great. Let's go to another one. Just picking a random one, NVIDIA. Let's go into here. Same thing, comes down here. The CCI is at lows, very lows, which tells us that we should be watching for a buy. And then it goes up to here. A MACD buy signal, off to the races. Staying above the 200-day moving average, the line is definitely looking like an upswing. Here you might have gotten out of. Yeah, absolutely, for the stop loss. And then we continue up further from here and maybe a repurchase end. So again, CCI is a watch. Let's watch what's happening. Is it coming to new lows? Is it happening? The MACD, a signal to buy and to jump in. The trigger, pull the trigger. Then we watch some of the other signs. Don't forget also watching the CCI turning positive. Use the average true range for a stop loss going back. We cannot finish by not speaking about Bitcoin. Let's just go back a little bit at Bitcoin. You look at here, CCI hitting lows, MACD buy signal. Throw out all the other signs, throw out, and we're off to the races, Then we have another opportunity. Even if we hit these lows, the MACD held, you would have sat 2 months not making money, but then the trend continued up higher. Look at recently what's going on with Bitcoin with the CCI. Right now, we are trading in a negative range. The overall market seems bearish for Bitcoin. We would love for it to sell off, CCI to go much lower, and then a MACD buy signal. This is what I'm waiting for. One of the indicators I use out of over 50 indicators. Key takeaways of the CCI. The CCI works in a variety of markets. The CCI is a powerful indicator. The CCI should not be used as a standalone indicator, but coupled with other indicators to use a weight of evidence. One indicator does not make a successful system. Please watch the other videos, MACD, RSI, etc., to combine these indicators to make a rule-based strategy. There are many interpretations of how to use the CCI. Many trading systems and software programs are based on the CCI. Study it, analyze it, adapt it. Peace!